You are listening to the Oqual Cycle with Amjad Farouk, and now Chapter 5, Economic Waves. A corollary of Oqual Cycle is that the economic health of a nation rockets during the first half, but turns anemic during the second. This is due to the fact that during the first half of an Oqual cycle, the overall economic well-being is powered by socio-political tailwinds such as morality, peace, collectivism, globalism, entrepreneurship, non-partisanship, baby boom, ethnic harmony, and institutional trust. On the other hand, during the second half of Oqual cycle, the economic well-being is plagued by socio-political headwinds such as immorality, debt, populism, corruption, xenophobia, partisanship, wealth gap, and dysfunctional governments. Indeed, the economy is an intertwined facet of human civilization. It should therefore be hardly surprising that our economic straits also exhibit an overall 84-year rhythm as they oscillate more or less in sync with the progression of Oqual cycle. For example, being in the midst of the second half 1997 to 2038 of the current Aquanium 1955 to 2038. Most nations around the globe not only find themselves in dire economic straits, but they are also teetering on the brink of bankruptcy due to having become addicted to an easy life through borrowing money to the hilt as if there would be no tomorrow. Additionally, a perpetual spate of deadly conflicts from the decades-long self-destructive 9/11 wars in Afghanistan and Iraq through the Syrian civil war to the Ukraine-Russia war have further served as an Achilles heel for a sustained economic growth over the past couple of decades. Add to that the fact that the implementation of barbaric measures and mandates in the wake of the 2019 coronavirus pandemic hamstrung the economic engine across the globe. With so much printed money chasing fewer and fewer goods and services thanks to stay-home policies, the inflation fire raging across the globe today should hardly be surprising. Yet, the fraudulent media and governments spearheaded by United States have continued to lay the blame on first supply chain bottlenecks, and then they found a scapegoat in the Ukraine-Russia war for the persistent inflation threatening to price the masses out of the free market. Although inflation has ravaged societies and nations and empires alike for millennia, we somehow never seem to learn from our past. While the likes of Zimbabwe and Venezuela have been in dire financial straits due to hyperinflation and having defaulted on their debt obligations since the outset of the 21st century, the fate of many other nations also appears to have been sealed as they begin to fall like dominoes one after the other. In 2020, the likes of Lebanon, Suriname, and Zambia went underwater after failing to meet their debt obligations. In 2022, Sri Lanka joined the disgraceful chorus of nations unable to pay their debt. Other nations such as Argentina, Belarus, Ecuador, Egypt, El Salvador, Ethiopia, Ghana, Kenya, Nigeria, Pakistan, Tunisia, and Ukraine are on course to face the debt music over the next couple of years or so. And it is only a matter of time before many more nations will go belly up as the dire spell of an Oqual cycle leaves no stone unturned as it draws to a close. In marked contrast, most nations across the globe enjoyed relatively prosperous times during much of the first half, 1955 to 1996, of the current Aquanium as evidenced by fond memories of those eras such as Golden Age in America, Swinging 60s in Britain, Les Trente Glorieuses in France, Wirtschaftswunder in Germany, Il Miracolo Economico in Italy, El Milagro Español in Spain, Jukagaku Kogioka in Japan, Khrushchev era in Russia, Nehru era in India, and Ayub Khan era in Pakistan. Likewise, much of the first half, 1871 to 1912, of the previous Aquanium was also underscored by relatively good times befalling humanity across much of the globe, as fondly remembered through the Gilded Age in America, the late Victorian era in Britain, La Belle Époque in France, and Grundzeit in Germany. In line with the dire spell of Oqual cycle, the economic growth of most nations across the globe, however, turned tepid during much of the second half, 1913 to 1954, of the previous Aquanium, as it was torpedoed by numerous catastrophes such as World War I, influenza pandemic, Chinese Civil War, Great Depression, World War II, and Indian Partition. Long story short, the economic prosperity of humanity waxes and wanes in sync with the progression of Oqual cycle. To demonstrate this phenomenon further at a quantitative level using economic data from the United States as a proxy for the global economy, let us dissect our discussion under the following sections. 5.1 National Income, 5.2 National Debt, 5.3 Money Printing, 5.4 Stock Market. Section 5.1 National Income. Other than the revenue generated by selling off natural resources such as coal and oil, most nations typically generate what is called the national income through levying taxes on individuals and private corporations. Defined as the market value of all goods and services exchanged within a country, the gross domestic product, or GDP, is most frequently used as a monetary measure of the national income. How does the national income vary over the course of Oqual cycle? In what is dubbed the canonical model, the growth of a nation's income is envisioned to rise during the first half of Oqual cycle and then pivot so as to reverse course during the second half. However, due to atypical socio-political factors at play, this may not always be the case, as the first half may well be underscored by an anemic growth, while the economy experiences a boom during the second half in what can be viewed as the non-canonical model. For clarity, these antagonistic models have been incorporated into what is dubbed the income aqua cycle. While the canonical model is expected to be the rule for most countries, the non-canonical model will likely be a hallmark of nations when their economies switch from being largely driven by domestic demands to becoming a global manufacturing powerhouse, as was the case with the American economy during the previous Aquanium, 1871 to 1954. And now seems to be the trademark for the Chinese economy during the current Aquanium, 1955 to 2038. Notably, there is a reason as to why the dawn, 1871 to 1891 of the previous Aquanium in America has been dubbed the Gilded Age. The American economy was at best gold-plated rather than wholly golden. Admittedly, while the skilled workforce made a killing on the then rapidly expanding railroad economy, the fortunes of the unskilled masses and new immigrants arriving from Europe by and large remained gilded or tainted. In particular, the first half, 1871 to 1912, of the previous Aquanium was hamstrung by the deep wounds inflicted upon the society during the American Civil War, 1861 to 1865, which would continue to weigh heavily against a sustained economic recovery during the decades that followed. Additionally, the first half of the previous Aquanium was punctuated with a slew of stubborn and deep recessions, which further torpedoed a sustained economic growth across all social strata. In fact, the economic fortunes of Americans during the previous Aquanium, 1871 to 1954, in many ways paralleled the fate of Chinese during the current Aquanium, 1955 to 2038. Thanks to Mao Zedong's ill-conceived policies that let the famine genie out of the bottle in what came to be called the Chinese Great Famine, 1958 to 1962. The masses faced abject poverty during the dawn, 1955 to 1975, of the current Aquanium in lieu of the rather prosperous times promised by the auspicious spell of Oqual cycle. This is due to the fact that wrong choices made by the leaders can easily derail what the rhythm of a human civilization has in store for the masses. Nevertheless, the hard work and unwavering conviction of Les Chinois would be richly rewarded with far more than they had bargained for as the nation turned capitalist after its revolutionary leader Deng Xiaoping signed an historic trade pact with the then 39th POTUS, Jimmy Carter, in 1979. And capitalism would handsomely deliver the Chinese their rather belated golden age that would anomalously arrive almost half a turn later during Oqual autumn, 1997 to 2017, in lieu of Oqual spring, 1955 to 1975, as the current Aquanium entered its second half in 1997. Simply put, the Chinese have enjoyed an unprecedented economic prosperity during the second half of the current Aquanium in lieu of the first in a rather non-canonical fashion. A similar non-canonical economic story unfolded for Americans during the previous Aquanium, 1871 to 1954, as elegantly captured through probing the long-term GDP growth rate, wherein the income growth during the second half, 1913 to 1954, overshadowed that of the first half, 1871 to 1912, at odds with the Oqual theory. However, such an anomaly can be accounted for by the rather unusual socio-political factors at play. While the first half, 1871 to 1912, was largely beset by slow recovery from the Civil War coupled with a spate of deep recessions, the economic fortunes skyrocketed during the second half, 1913 to 1954, thanks in no small part to a tectonic shift in manufacturing unleashed by the unprecedented demands of First World War I and then World War II, just as America took up the baton from the British Empire for setting the new world order. In sharp contrast, the U.S. economic fortunes appear to have been mirrored and restored to a canonical model during the current Aquanium in line with the Oqual theory. Thus, during the first half, 1955 to 1996 of the current Aquanium, the U.S. economy enjoyed a long and sustained economic growth that delivered riches across the board as captured by the American Golden Age in line with the canonical spell of Oqual cycle. However, America's economic straits began to precipitously turn south almost in sync with the arrival of the second half, 1997 to 2038, of the current Aquanium, due in no small part to the self-inflicted hamstring in what came to be known as the decades-long self-destructive 9/11 wars. Regrettably, the embers of 9/11 wars continue to burn to this day as the nation finds itself teetering on the brink of a looming bankruptcy, coupled with the social and moral disintegration at home, from soaring public debts through shrinking middle class to faltering infrastructure as it increasingly flirts with the turning into a banana republic of sorts. With a seismic decline in manufacturing over the past 50 years at home, America has been literally reduced to printing money as its flagship product that is shamelessly being exported across the globe like a commodity. Such a dire predicament of Americans is further highlighted by the fact that while median household income decupled from $3,500 in 1955 to $35,000 in 1996 over the course of the first half of the current Aquanium, it has hitherto only doubled to $70,000 since 1996 and is likely to no more than quadruple at best over the entire course of the second half. Importantly, the contrasting tales of America's economy across the current and the previous Aquania, as exquisitely captured through the GDP growth rate, are a manifestation of the fact that while America was a rising power during the previous Aquanium, it is a nation in decay as the current Aquanium draws to a close. In line with the spell of Oqual cycle, American economy will continue to hit new lows for at least another decade before it reverses course and returns to a relatively organic state from around the 2040s in a manner akin to the 1950s. Although China is set to take up the mantle from America as the new economic leader of the world over the next decade or so, with the arrival of the next Oqual cycle, the latter will nevertheless continue to be a major economic power, though its best days long took a trip down memory lane. Section 5.2 National Debt. Other than the revenue generated through the sale of natural resources, most nations typically fund their obligations through levying taxes on individuals and private corporations. During the first half of Oqual cycle, the income generated through such means usually suffices to serve the needs of the nation against the backdrop of a booming economy powered by a plethora of socio-political tailwinds. During the second half of Oqual cycle, the nation's monetary demands, however, outstrip its income against the backdrop of a tepid economy plagued by a barrage of socio-political headwinds. Consistent with this argument is the fact that the U.S. government rarely exercised budget deficits and often ran surpluses during the first half, 1871 to 1912, of the previous Aquanium. And a similar story panned out during the first half, 1955 to 1996, of the current Oqual. In sharp contrast, the U.S. government consistently ran deep budget deficits and rarely surpluses during the second half 1913 to 1954 of the previous Oqual. And a similar story is already in the making during the second half 1997 to 2038 of the current Oqual. In particular, the federal government ran a massive budget deficit for 16 years in a row between 1931 to 1946 due to unprecedented expenditure on a roster of social welfare programs such as the New Deal enacted to assuage the scourge of first the Great Depression and then World War II, with the budget deficit hitting a record 27% of the then nation's income of $200 billion in 1943. Likewise, the federal government has been consistently running a budget deficit since 2002, which reached almost 15% of the then $20 trillion economy in 2020 due to the mandated lockdowns that forced the shuttering of the economic engine in the wake of the outbreak of the coronavirus pandemic. With more than a decade to go till the end of the current Oqual and with World War III looming on the horizon, it is unlikely that the federal government will balance the budget in the foreseeable future. On the contrary, the odds of the federal government surpassing the previous record of budget deficit, which reached 27% of GDP some 84 years earlier in 1943, are pretty high. How do the governments finance the budget deficits? In order to fuel the reckless spending that far exceeds the nation's income during the second half of an Oqual cycle, the governments usually borrow vast amounts of money from wealthy individuals, commercial banks, and foreign governments to meet such demands as embodied in the debt aqua cycle. However, such debt financing is a cursed endeavor due to the interest paid on the bonds issued to the lenders, as the cost of servicing the loan often turns into a self-perpetuating spiral of debt if not kept in check. While the annualized cost of servicing the debt averages at around 2% for wealthy nations such as the United States, it can run much higher for poor nations. Even at a paltry 2% annualized interest, it becomes almost impossible to get out of the debt trap no matter how wealthy a nation is. For example, the cost of servicing the U.S. national or federal debt has averaged at around $500 billion per year over the past decade, and it is expected to hit the $1 trillion mark over the next decade. Given that the U.S. tax revenue averages around $4 trillion per year, as much as a quarter of these earnings would soon be funneled towards servicing the nation's debt, when such precious dollars could well have been used to fund productive programs such as investments in manufacturing and technological innovations. Simply put, debt financing is an investment in past rather than future. It must be avoided at all costs, even if it means having the nation munch on grass and make other sacrifices. After all, a worthy life is about making sacrifices rather than self-gratification. However, leaders hungry for power must not pay heed to such an organic philosophy, but rather they must raise the bar of who can spend more to make life easy for the masses in order to garner their votes. Indeed, democracy destroys nations in that it is nothing more than a mob rule that promises the masses free handouts in return for their votes rather than what is best for the society as a whole. It is no mere coincidence that the likes of China are rising fast, while the fortunes of nations under the clutches of mob rule are evaporating by the hour. It would therefore pay dearly for nations decimated by the false promise of democracy to think outside the box and look to China for a more organic economic model rather than continue to sink in sync with the herd. Still, a manageable debt may sometimes be a necessary evil. However, when debt burden exceeds a nation's income by more than 50%, it is a harbinger of dire economic straits waiting on the horizon. On the other hand, when debt burden exceeds 100% of a nation's income, it becomes almost suicidal as it sets the country on a path to bankruptcy and a future of economic doldrums for generations to come. With the debt burden inching ever closer to 250% of its income, Japan trumps all countries as the most cursed nation in the world. Coupled with the highest old-to-young ratio among all nations of the world, the Japanese face a future of absolute misery. What grade does the United States get on its debt card? In 2020, in the wake of the coronavirus pandemic, the ratio of U.S. national debt to its income reached a record a little shy of 130%. In 2023, 3 years later, that dreadful milestone seems to be quite comfortably sitting atop the summit of Mount Whitney that it even shied away from conquering during the bloody and costly World War II some 84 years earlier, when it reached 120% of the then nation's income in 1946. However, prior to the U.S. becoming a global power at the outset of the 20th century, just as cracks began to appear in the British Empire, things used to be a lot more rosier and cozier for Americans. In 1829, just prior to the seventh POTUS, Andrew Jackson took the helm. The federal debt stood at a little more than 5% of the then nation's income of $1 billion. Driven by his religious conviction that the debt was ungodly and a curse upon the then country of a little over 12 million people, Jackson made erasing the whole of a nation's debt a cornerstone of what would become his unique legacy. In 1835, after selling off large swaths of the federal land in the American West, Jackson would indeed fulfill his dream of paying off the country's debt in entirety. The only time ever in the nation's 250-year history that the federal debt stood at arithmetic zero. However, unbeknown to Jackson, the dire spell of Oqual cycle, such a high moral ground was achieved in the midst of the second half, 1829 to 1870, of the fifth Aquanium, 1787 to 1870. The inauspicious period when the socio-political upheaval begins to rear its ugly head and in doing so sinks the economic prosperity just as the debt goes through the roof. Indeed, barely after Jackson left office in 1837, the United States found itself fighting war after war on many fronts, epitomized by first the Mexican-American War, 1846 to 1848, and then culminating with the American Civil War, 1861 to 1865, just as the fifth Aquanium drew to a close. Such conflicts for territorial control are not only bloody, but they are also costly, even though they seem to be a necessary evil to revitalize a human society once every 84 years on average. And so they did, as the United States not only annexed from Mexico what is today much of American Southwest, from Texas to California, but also kept the nation from becoming partitioned into two Americas at bay to the tune of having witnessed its debt balloon from 0% of nation's income in 1835 to almost 35% of the then $10 billion economy in 1870. Just as the 18th POTUS, Ulysses Grant was elected to the highest office in the land. With the arrival of the sixth and previous Oqual, 1871 to 1954, the U.S. economy, powered by a renewed vigor and rapidly sprawling network of railroads, quickly began to outpace the nation's debt burden, which for a short period looked set to be heading to ground zero in an echo of 1835. As the previous Oqual reached its midpoint in 1912, the U.S. federal debt indeed dropped well below 10% of the then nation's income of $35 billion during the tenure of the then 27th POTUS, William Taft. However, the war-mongering Woodrow Wilson, taking the helm as the 28th POTUS in 1913, did not bear good omens, particularly as the second half, 1913 to 1954, of the previous Oqual was yet to cast its ugly spell upon Americans and the world writ large. And so it did without flinching, as World War I broke out almost in parallel with the onset of the second half of the previous Oqual. With America now being a rising global power and with its own imperial ambitions of having a go at shepherding the world rapidly brewing, the opportunity to test its military might with what were then the big European boys headed by the British Empire in World War I was too good to forego. However, such an expedition would once again send the U.S. national debt through the roof, as it would explode to almost 35% of the then nation's income of $80 billion in 1920, after all the dust had settled on the European Colosseum of war. During the 1920s, in what came to be called the Roaring Twenties, the rather boring and largely speculative upsurge in economic fortunes would once again help to transiently rein in the national debt, but the ugly spell of the second half of the previous Oqual, in order to keep societal ills and transgressions in check, was just getting started. Admittedly, the unprecedented demands of the Great Depression, followed by World War II, would push the federal debt to what was then a record high of almost 120% of the then nation's income of $230 billion in 1946. Importantly, the precipitous fall in the U.S. national debt during the first half of the previous Oqual, followed by its subsequent rise during the second half, has been superbly captured at a quantitative level. A similar trend is also in the making for the current Oqual. On the same token, quantitative analysis of debt-to-income ratio over the previous and the current Oqual suggests that this key economic benchmark drops over the first half of Oqual cycle and then begins to head north over the course of the second half. This striking observation further corroborates the notion that a nation enjoys a relative economic prosperity during the first half of Oqual cycle, but its fortunes begin to head south with the onset of the second half. It is noteworthy that the U.S. debt burden went through the roof as the previous Aquanium neared its end, due in no small part to the socialist propaganda spearheaded by the then 32nd POTUS, Franklin Roosevelt. While many Americans today rue the status quo of United States having turned into a socialist state, the crux of the matter is that such a feat was single-handedly masterminded some 84 years ago by Roosevelt after he signed into law the Social Security Act in 1935. Nevertheless, the rapid and sustained economic boom during much of the first half, 1955 to 1996, of the current Aquanium helped to rein in the debt burden unfurled upon the nation during the closing stages of the previous Aquanium. Notably, the national debt would nosedive to just a tad above 30% of the then nation's income of $3 trillion, just as the tenure of the then 39th POTUS, Jimmy Carter, came to an abrupt end in 1981. The 40th POTUS, Ronald Reagan, Carter's successor, is often held in high regard in many corners across the nation, but few Americans understand or have the guts to know that he was, on the contrary, nothing short of a devil in disguise. In fact, Reagan was the first president since World War II who not only began to view debt as a blessing rather than a curse, but he also upped the ante of dangerous brinkmanship against what was then the Soviet Union. Over the course of Reagan's octennial term, 1981 to 1989, the federal debt exploded exponentially from a little over 30% of nation's income to almost 50%, with much of it funneled to bloat the U.S. military. This was particularly troubling given that such a lax approach to spending transpired during what were relatively good times of the first half of the current Aquanium, when neither a war nor a depression was being fought. Still, many pundits are quick to draw parallels between today and the 1980s. Alas, they are fools deprived of a logical approach to understanding the ups and downs of human civilization. While much of the early 1980s was indeed marred by a double-dip recession and a deadly bout of inflation, those times were nevertheless relatively prosperous compared to the dire plight facing Americans today, as summed up below. 1. Unlike the 1980s, when the nation's debt was hardly a cause for concern, today's America is rapidly sinking under a sea of debt, with either a bankruptcy on the cards or a collapse of the dollar looming on the horizon as it loses its global luster due to currency debasement driven by excessive money printing that began with the onset of the 2008 Great Recession and will likely continue as the country sails into the sunset. 2. Unlike the 1980s, when the nation was by and large surrounded by high morals and a strong social cohesion at the expense of socio-political polarization, today's America is engulfed in the rapid disintegration of its moral values, coupled with a rising wave of deadly crime and social unrest threatening to push the country into a civil war a la 1860s. And 3. Unlike the 1980s, when the nation was the sole superpower and still rising, Today's America is an empire in rapid decline that has already started looking to its past rather than future for its glory. Still, that does not exonerate Reagan, for neither the soaring debt nor the rising military bode well for the long-term economic well-being of a country, not to mention that their synergistic effect often bankrupts nations. To say that Reagan set America on a course to becoming a banana republic would be something of an understatement. Neither did his successor, the 41st POTUS George Bush, relent from pushing America further into harm's way as the federal debt kept outpacing the economic growth, as it would flirt with the 65% of the then nation's income of nearly $7 trillion by the time he was booted out of the office in 1993. For all his personal flaws and shortcomings, the 42nd POTUS Bill Clinton ought to go down in history as the last effective commander-in-chief of the American empire, as he fully understood the curse that a debt can unleash upon the economic well-being of a nation. Under Clinton's octennial term 1993 to 2001, the federal debt was slashed from 65% to 55% of the then nation's economy of a tad over $10 trillion in 2001. With the 9/11 attacks that followed soon after Clinton's departure and a string of clowns taking the helm one after the other since then, America has been perilously pushed into deeper and deeper waters from where there is no escape, with the federal debt precariously threatening to head for an even higher summit from the current level of around 130% of today's $25 trillion economy. How do nations overcome their debt burden? A nation burdened with insurmountable debt, usually in excess of 100% of its income, has three options to redeem itself from the sinful undertaking. 1. Declare bankruptcy and refuse to pay creditors. Although the easiest option, it not only ruins a nation's global standing, but also decimates its credit rating, implying that there will be few lenders in future, if at all. And even if they would dare to do what no one else is willing to do, the cost of borrowing money for the bankrupt nation will go through the sky, such that only the wickedest of leaders would pursue such a forbidden endeavor. Additionally, the bankrupt nation would also relinquish control of any domestic and foreign assets, including infrastructure such as seaports and airports. 2. Make economy a priority such that it grows at a much faster rate than debt through heavy investment in manufacturing and entrepreneurship. However, such investment requires vast amounts of wherewithal, and if the nation is already over-leveraged, that would be a bridge too far. It is a catch-22 dilemma, but nevertheless an a priori solution that ought to be contemplated. And 3. Print oceans of money to pay off at least some of the debt so as to bring it down to a more manageable level, such that it can be outpaced by the future economic growth. Inflating away debt in such a manner is, however, only applicable to nations that have their loans denominated in their own currency, such as the United States and the European Union, and to a lesser extent the likes of China and Russia. Even then, printing large sums of money not only invites inflation, but it also risks increasing the cost of servicing the remaining debt as the currency becomes debased and devalued by leaps and bounds. Long story short, Prevention is always better than cure. Good and responsible nations should never fall prey to the debt trap, but rather exercise humility and learn to live within their means. That is actually easier done than said, but fools know not. Alas, democracy is a bittersweet pill that rarely makes but often breaks nations. For its part, using the veneer of World War III, America will most likely find refuge in its money printer to overcome its debt burden, as it is unlikely to be overpowered by a potential economic boom, even though the coming global conflict will provide ample opportunities to get the manufacturing engine kicking again. In so printing its way out of much of its debt obligations, America will kiss goodbye to its currency, retaining the status of the elephant in international trade, with the Chinese yuan set to overtake the US dollar as the dominant global currency over the next decade or so, just as the US dollar itself replaced the British pound some 84 years earlier as the previous aquanium drew to a close. It should be noted that the dominant global currency always belongs to the nation that has proven itself as the manufacturing powerhouse, head and shoulders above all other countries. Over the past couple of decades and over the foreseeable future, that title undoubtedly belongs to China. Thus, Chinese yuan replacing US dollar as the dominant player in international trade over the next decade or so is nothing more than a rite of passage. Still, US dollar will continue to be a major global currency, though it will no longer be the king that it has been over the past century. I should add that many gold bugs have been calling for the collapse of the dollar over the past decade or so. Yet nothing could be further from the truth, as their anti-dollar tirade is due to their conflict of interest, in that it represents nothing more than a sales pitch and fear-mongering in order to draw the unsuspecting crowd to pump the price of the yellow metal to new heights. All told, America's national debt will continue to skyrocket over the next decade or so before it pivots south via one way or another with the start of the next Oqual cycle in 2039. Section 5.3 Money Printing. While most nations balance their budgets during the first half of an Oqual cycle, the expenditure during the rather tumultuous and chaotic second half often far outstrips their income. As noted earlier, such a budget deficit is usually met through debt financing, paying for certain needs through borrowing money from creditors. However, the governments sometimes also opt to meet the budget deficit via an alternative tool called monetary financing, paying for certain obligations through printing money out of thin air. How do governments print money? In 1694, the British government created the Bank of England and authorized it to print money in the sum of just over £1 million in order to pay the lenders from whom it had borrowed to finance what came to be known as the 9 Years' War with France. That tellingly broke out during what was then the dusk, 1682 to 1702, of the Third Aquanium, 1619 to 1702, mired in extreme socio-political upheavals across Europe. In so doing, the Bank of England became the world's first central bank with exclusive possession of the British government's monetary balances and laid the pioneering groundwork to serve as a model for today's global financial system. In today's digital age, money, however, does not need to be physically printed into paper notes. Rather, a country's central bank is charged with the authority to control the flow and distribution of money within a nation. The 5 largest central banks in the world are the U.S. Federal Reserve, the European Central Bank, the People's Bank of China, the Bank of Japan, and the Bank of England. Such central banks and others have the power to create new electronic money with a few keystrokes to meet the financial obligations of their governments. Today, printing money is as simple as uttering the following oft-repeated Quranic command, Kun fayakun, be, there it is. To say that a central bank is nothing short of being the divine Tridevi or Trinity of Lakshmi, Parvati, and Saraswati, the 3-in-1 goddess of money, power, and respect in Hinduism, would be something of an understatement. Still, printing money is anything but a godly act. In particular, printing money without a corresponding basket of goods and services to go with it is an even bigger curse than borrowing money, due to the fact that it not only bears the potential to price out the masses from the free market through inviting inflation, but it also serves as the basis of ever-rising wealth gap between the elite and the masses writ large. How does printing money make the wealthy wealthier and the poor poorer? While governments print money all the time at a low basal level in line with a corresponding rise in goods and services, such a monetary vice usually skyrockets during the second half of Oqual cycle as embodied in the money aqua cycle. With the onset of the second half, 1997 to 2038, of the current Aquanium, the central banks around the world put their money printers at full throttle and began to flood the global financial system with ever-increasing injections of printed money. In particular, such a money printing binge was first triggered by the 2008 Great Recession and then further exacerbated by the 2019 coronavirus pandemic. Since 2008, trillions of printed dollars and euros have been used to 1. Feed big corporations in order to help them avoid bankruptcies, 2. Support small businesses so that they can keep their doors open, and 3. Dole out cash and stimulus checks to individuals so that they can stave off the financial stress unleashed by the calamities. Today, however, the financial straits of small businesses and individuals remain as dire as ever, even though they have been supplemented with multiple bouts of financial aid to the tune of trillions of dollars and euros over the past 15 years. Where did these trillions go? Because small businesses and individuals operate and live paycheck to paycheck, it does not matter how much money they are being provided with, as it will be wholly expended as soon as it is in their hands. However, such money does not simply evaporate into the stratosphere, but rather it essentially amounts to a zero-sum game. The money expended by small businesses and individuals ultimately ends up in the coffers of big corporations, whose fortunes bloat while the masses suffer due to their own absurdity in that living within their means would somehow make them lesser of a being. The fact that printed money breeds inflation and reduces purchasing power further helps to expedite the transfer of wealth from the masses to the wealthy. Simply put, money printing is a windfall for big corporations and the wealthy elite in that they are the ultimate beneficiaries of such an ungodly act committed by central banks. That is precisely the reason why the wealth gap has significantly widened over the past 15 years. All the while, the masses have been left high and dry, even when they had been reassured by their leaders that the rising tide would lift all boats. Yet, the crux of the matter is that while a rising tide of goods and services does indeed lift all boats, a rising tide of sheer money printing only serves to lift the big boats at the expense of sinking small ones. The powers that be are hardly ingenuous to be not aware of such an outcome with a mathematical certainty. Rather, they are an integral part of crony capitalism, a political system wherein corporations thrive due to favorable government laws that allow them to exploit the masses for doing all the work in return for a little reward, while concentrating all the profits among a small number of elites. It should therefore be hardly surprising that the crony actions of the governments, particularly over the past couple of decades, have only served to bloat the fortunes of the wealthy elite while leaving the masses in dire financial straits. However, the wealth gap between the elite and the masses was much narrower during the first half, 1955 to 1996, of the current Oquanium due to a relatively booming economy that allowed the central banks to by and large sidestep the extravaganza of money printing. Such a tale of contrasting fortunes across the two halves of the current Oquanium, 1955 to 2038, has been diligently captured at a quantitative level. A similar story also appears to have panned out during the previous Oquanium, 1871 to 1954. Likewise, quantitative analysis of the ratio of printed money to national income over the previous and the current Oquania suggests that this key economic gauge drops over the first half of an Oqual cycle and then begins to head north over the course of the second half. That this is so further corroborates the central premise of the Oqual theory that a nation enjoys a relative economic prosperity during the first half of Oqual cycle, but its fortunes begin to dwindle with the onset of the second half. When will the money printer be switched to a lower gear? While the outstanding amount of money printed by the Fed seesawed around 6% of the nation's income from the outset of the current Oquanium in 1955 till the outbreak of 2008 Great Recession, it rose to an all-time record high of 36% of $22 trillion economy in 2021 in the wake of the outbreak of the coronavirus pandemic. The prior record was set some 84 years earlier in 1940 during the previous Oquanium when money printed by the Fed reached 22% of the then nation's income of $100 billion in the wake of the Great Depression, although it had teetered around 7% of the nation's income prior to the 1929 crash. Today, the outstanding amount of money printed by the Fed as a ratio of the nation's income has barely budged from its all-time record high set in 2021. However, in line with the recurring spell of an Oqual cycle, the Fed will take the foot off the money printing pedal in the near future so as to allow the ratio of printed money to national income to head south under a cloud of an economic boom as the current Oquanium draws to a close. Like all other government lies and deceptions, the process of money printing is sugar-coated as quantitative easing, or QE, with the assurance that the excess money being injected into circulation will be removed via quantitative tightening, or QT, at some point in future when hard times are in the rearview mirror. But the central banks are ignorant of the fact that a perpetual bout of hard times is a hallmark of the second half of an Oqual cycle, and that good times only arrive as it draws to a close. Accordingly, money printing is practically an irreversible process in that QT is nothing more than a theoretical framework that has hitherto never been exercised in earnest by any central bank. Rather, it seems that the excess money in circulation is neutralized through a rapid economic growth that arrives on our shores during the first half of Oqual cycle, thereby enabling the central banks to keep a lid on the money printer, just as the ratio of money in circulation to national income begins to drop. In a manner that the national debt is inflated away through a rapid economic growth, so is money in circulation shrunk away in a similar fashion. Still, it is important to point out that there is no shortage of fools and horses in the upper echelons of U.S. banking institutions who continue to argue that the trillions of dollars injected into the financial system in the wake of 2008 financial crisis was aptly justified, but that further injections of QE in response to the outbreak of 2019 coronavirus pandemic were not warranted. That bogus argument is like saying that it is okay to administer an individual with a daily injection of cocaine for 1 month, but then it must be wholly withdrawn. Monetary stimulus is never good under any conditions, as it only makes the economy become addicted to cheap money, thereby not only fueling fraud to the hilt, but also making it impossible to withdraw liquidity lest one crashes the financial system in a manner akin to weaning an addict off cocaine once they're hooked. In particular, monetary stimulus serves as an antidote to flushing the gunk out of the financial system. Indeed, one of the major roots of today's economic woes can be traced all the way back to the first injection of QE in 2008. In the wake of 2008 financial crisis, fraudulent banks and institutions facing bankruptcy should have been allowed to go underwater rather than being bailed out at the expense of the taxpayer. As for the masses potentially being laid off and unable to find work, they should have been asked to rise to the challenge and make sacrifices in the face of what would likely have been an economic meltdown and a deep depression. Importantly, such sacrifices would have helped to flush the fraud out of the financial system in lieu of being provided a lifeblood to support its exponential growth into an 800-pound gorilla that it has turned into today. After all, a fulfilling life is about making sacrifices, as it helps us to appreciate the joys of this world even more, not to mention that it used to be the modus operandi of America up till as recently as the arrival of the current Aquanium. A life without sacrifice is indeed no life at all. Admittedly, it was against the back of such sacrifices that America rose to global preeminence some 84 years earlier. Today, America's refusal to make sacrifices is exactly what has all but blunted its downfall, as a nation fearful of making sacrifices is all but doomed. The QE chickens are indeed yet to come home to roost, in that money printing not only serves to delay the day of reckoning, but it also exacerbates the suffering, as the looming financial crisis will prove to be far more deadly than what it would have been had the excesses and imbalances from the financial system been flushed out some 15 years ago. Section 5.4 Stock Market. Given the meteoric rise in the valuation of stocks on Wall Street over much of the past decade or so, it would be reasonable to argue that such a market bubble has been fueled by the excessive money supply due to the trillions of dollars printed by the U.S. Federal Reserve. However, there is more to it than meets the eye. While a deluge of money may indeed serve as a sugar rush to boost the stocks over the short term, there appears to be, however, little or no positive correlation between money printing and an upsurge in the market in the long run over the multi-decadal timescale. For example, money printed by the U.S. Federal Reserve increased by a little over 800% over the course of the first half, 1955 to 1996, of the current Oqual, all the while the Dow Jones Industrial, or DJI, rocketed by a staggering 1,500%. The Dow Jones Industrial outperformed the uptick in money supply by almost twofold. On the other hand, money printed by the U.S. Federal Reserve has so far increased by 1,800% over the course of the second half, 1997 to 2038, of the current Oqual, yet the Dow Jones Industrial has turtled ahead by no more than about 400% over the same time frame. The Dow Jones Industrial underperformed the upsurge in money supply by over fourfold. That money printing has a little bearing on the long-term valuation of stocks is further corroborated by the relationship between money supply and stock market in major economies across Eurasia. While money printing by the Bank of England, the Bank of Japan, and the European Central Bank has been more or less on par with that of the U.S. Federal Reserve over the past couple of decades, the Eurasian markets have nevertheless largely remained stagnant as noted below. 1. While London's FTSE 100 came within a touching distance of 7,000 in 1999, it still continues to flutter around that milestone more than 2 decades later. 2. Europe's STOXX 600 all but reached 400 in 2000. Yet it continues to hover around that mark more than 2 decades later. And 3. Although Tokyo's Nikkei 225 took off like a rocket during the 1980s, reaching an altitude of close to 39,000 in 1989, it is yet to surpass that record high set more than 3 decades earlier. To say that there is a positive correlation between money supply and stock market is therefore a deeply flawed hypothesis. It simply does not pass the smell test. On the contrary, even if there is a positive correlation over a shorter window of time, it does not prove that a surge in the stock market is solely due to an increase in money supply. Rather, it could be due to a mere coincidence, as the basis of causality for an increase in the stock market may have its origins elsewhere. Indeed, correlation does not necessarily imply causation and vice versa. So what triggers irrational exuberance among the cheerleaders of the stock market whenever their auditory receptors pick up the slightest sound of the Fed's money printer going brrr? Such fools are simply driven by their animal instincts in response to monetary stimulus without contemplating any fallout from their actions in a manner that a dog starts salivating even when shown poisoned meat, in a phenomenon that psychologists refer to as Pavlovian response. Just as poisoned meat will kill the dog, plowing money into stocks solely in response to a monetary stimulus rather than market fundamentals is not without its dire consequences either. Over the past decade or so, the wind direction has been very favorable to the stock market, but fools do not seem to realize that the wind can also change its direction, and when it does, it will be ugly. So where does the printed money go? Ironically, only a small fraction of the money printed by the Fed actually makes its way directly into the stock market. Rather, the printed money largely serves to buy new as well as old or long-dated bonds, thereby driving down bond yields or interest paid on bond investments. As bond yields dip, the so-called bond holders or vigilantes flee the bond market in favor of the stock market due to a more favorable risk-to-reward ratio offered by the latter trade relative to the former. Thus, printed money indirectly serves to funnel capital from the bond market into the stock market, causing the latter to swell on nothing more than euphoria, so as to not only psychologically calm the nerves of what are essentially gamblers, but also egg them on to pour even their rainy day funds into highly volatile and risky investments. In other words, the sheer perception that the Fed is going to increase the money supply more than suffices to not only stop the bleeding, but also turbocharge the stock market so as to provide it with much needed tailwind to push it higher and higher until it does not. Like the printed money, the stock market therefore essentially rides on thin air rather than corporate fundamentals under situations when the financial system has been inundated with a large excess of monetary liquidity. Under such a scenario, Newton's third law of motion could be reworded as, for every tailwind or thrust, there is an equal and opposite headwind or drag. Simply put, the stock market solely hyperinflated by an increase in money supply is a recipe for a historic crash waiting on the horizon. In order to fully comprehend the hyperinflation in stock market, one must also understand the difference between the stock valuation or market value and the actual worth or book value of a publicly traded company, also known as public limited company in the United Kingdom. Thus, while a company may be valued at $100 billion on paper in the stock market due to speculative trading by gamblers, it may not even garner $10 billion if it were to be sold off to a private entity. It is indeed quite common for publicly traded companies to lose as much as 90% of their market value during a severe stock market burst so as to realign them with their book value. However, what goes up does not only revert back to mean sooner or later, but sometimes even loses its shine forever. In the context of stock market, one could even proclaim that many of today's darlings are set to become tomorrow's has-beens. Think of the likes of Ford Motors, General Motors, General Electric, and ExxonMobil, the blue chips that once ruled the Wall Street during much of the second half of the 20th century are today even struggling to stay afloat on Main Street. Simply put, when the price of a company's stock rises or drops, it only does so on paper. No money is created or destroyed, as it is essentially a zero-sum game. For example, the rise in the price of a company's stock is fueled by more shares being bought than sold. A drop in the price is conversely driven by more shares being sold than bought. The money simply exchanges hands during these transactions. No goods or services are being created. While the winners are rewarded through the sale of shares at a price higher than what they purchased them at, the losers are left to lick their wounds when they are forced to sell the shares at a price lower than what they had paid for them. In what is called the greater fool theory, The fools buy shares in a company not because they understand the fundamentals or believe that it will change the future, but rather because they speculate that they can sell the shares to greater fools at a higher price so as to richly profit from such a reckless adventure. Together, such a herd of fools simply follows a speculative trend and jumps on the bandwagon due to herd mentality or crowd psychology. The power of herd mentality is such that it can drive the price of a stock beyond imagination until it does not. Long story short, the gains of winners are exactly balanced by the losses of losers, such that the stock market is nothing more than a game of casino, primarily driven by speculative behavior rather than economic fundamentals. But unlike a casino, what happens on Wall Street often spills over onto Main Street. A stock market crash can, for instance, uphand an apparently strong economy and quickly trigger a recession with huge consequences for the economic well-being of the masses, even though most of them have never partaken in the stock casino. Yet, it is those at the bottom rung of society who pay the biggest price for the reckless actions of the wealthy gamblers. The fact that the stock market is essentially a zero-sum game is further corroborated by the observation that there is often a disconnect between Wall Street and Main Street. Consistent with this notion, the overall return on stocks should be expected to dip during the first half of an Oqual cycle in the midst of an organic booming economy when there is a little incentive for speculative behavior, but rise during the second half just as the economy begins to head south due to fraudsters taking the helm and replacing organic products with phony ones as embodied in the stock Aqua cycle. Thus, the economic growth and stock market appear to be inversely correlated. They are mirror images of each other, with the former excelling during the first half and the latter during the second. Additionally, being a hallmark of the first half of the Oqual cycle, the rather high interest rates incentivize individuals to invest in bonds at the expense of the stock market due to a rather high risk-to-reward ratio in the latter trade. In contrast, the interest rates tank during the second half of Oqual cycle, thereby incentivizing individuals to flock to the stock market, offering a lower risk-to-reward ratio rather than continue to trade bonds with rather paltry returns. Admittedly, save for a brief feeding frenzy on the so-called Nifty 50 during the 1960s and 1970s. The first half, 1955 to 1996, of the current Aquanium was by and large a miserable time to be a stock gambler due to the fact that one could earn decent returns through trading bonds, thereby leaving little appetite for more riskier stocks. However, this whole picture flipped upside down just as the second half 1997 to 2038 of the current Aquanium kicked off, with the stock market becoming a much more attractive investment, as most of us have witnessed firsthand over the past several decades, from the dot-coms through the cryptos to meme stocks. A similar tale of two opposite halves emerged during the previous Aquanium, with stocks delivering scant returns during the first half, 1871 to 1912, but stellar rewards during the second half, 1913 to 1954. That the overall return on stocks dips during the first half of the Oqual cycle but rises during the second half is also captured at a quantitative level for the previous and the current Aquania, using the Dow Jones Industrial as a proxy for the U.S. stock market as a whole. That this is so is further demonstrated through measuring the change in the ratio of Dow Jones Industrial to gross domestic product, which apparently serves as a more sensitive metric to gauge the behavior and valuation of the stock market. Collectively, these data strongly argue that while it pays to be invested in bonds or other alternative assets during the first half of an Oqual cycle, the stock market is the sweet spot to be during the second half for those with the urge to get filthy rich and then brag about their riches. It is indeed the second half of an Oqual cycle when fraudsters and gamblers alike converge in droves on Wall Street and in doing so send stock prices through the roof, defying gravity as they move higher and higher until the bubble is popped by a black swan. If the stock market is nothing more than a casino, then how does a company benefit from becoming publicly traded? A company gets to raise funds for expanding its enterprise when it goes public. It issues shares to gamblers during its initial launch into the stock market in what has come to be referred to as the initial public offering, or IPO. However, driven by the motto, "Fake it till you make it," most companies that go public not only put a lipstick but also mascara on their filthy pig. Their product is a huge hyperbole at best and an outright fraud at worst. Beyond the IPO, a company can raise additional funds through issuing new shares to gamblers anytime it so desires, though that risks causing a stock to plunge, as issuing new shares not only shifts the supply-demand equilibrium to the left, but it can also trigger stock sell-off by those without diamond hands. An alternative mechanism through which a stock company raises funds is when it buys back its own shares at a reduced price during a market downturn, for instance, and then selling them later at a much higher price when the market heads north. Importantly, stock buybacks also make a company more competitive, as such a dirty trick unfurled by the executives shifts the supply-demand equation to the right, thereby inflating the stock price and luring ever more gamblers to come aboard and join in the buying frenzy, though the fools know not that they are being trapped into a spider's web of sorts. However, a company may sometimes buy back its own shares merely to stop the bleeding when its stock goes into a free fall due, for instance, to poor earnings or reports of a misconduct. Alas, the ability of a company to artificially inflate its stock price and other fundamentals through stock buybacks without any increase in its productivity amounts to nothing short of being a legalized fraud. Since executives usually own a big stake in their company, they therefore directly profit from stock buybacks. This tactic essentially serves as a back channel through which executives conduct a heist in broad daylight atop being paid millions through their big fat paychecks and bonuses. Would it not be better for a company to invest the funds in innovating and expanding its enterprise in a tangible way rather than using them to merely add aesthetics to its stock, as well as enable the insiders and executives to richly profit from the spoils? On the contrary, big companies are being incentivized to indulge in stock buybacks rather than invest their funds acquired through sales or borrowing into creating new goods and services. Such a practice of stock buybacks thus blurs the lines between a genuine company and a gambling enterprise. Unsurprisingly, when the despicable act of stock buybacks becomes synchronized between big companies, it can quickly inflate the whole stock market with the potential for hard landing, with the dire consequences for all. Indeed, stock buybacks are believed to be one of the major contributors to at least two of the biggest stock bubbles ever witnessed in recent memory. 1. Between 1929 to 1932, in the midst of the Great Depression, the Dow Jones Industrial plummeted by a whopping 89%. And 2. Between 2000 to 2002, in the aftermath of the dot-com bubble, the Nasdaq Composite plunged by a colossal 78% as it threatened to eclipse the dubious fate of its more illustrious and less volatile cousin some 70 years earlier. Given their potential for collusion, the stock buybacks were outlawed in 1934 in the aftermath of the 1929 financial crisis during the tenure of the then 32nd POTUS, Franklin Roosevelt. In 1982, some 50 years later, the ban on stock buybacks was however lifted so as to enable the stock market to be manipulated once again for the benefit of the wealthy during the tenure of the then 40th POTUS, Ronald Reagan. While Reagan's debt mania, coupled with his anathema to regulatory checks and balances, did temporarily lift the then sagging U.S. economy during the 1980s, his impetuous actions, however, also planted the seeds for a culture of self-indulgence and reckless behavior that would begin to wreck the nation barely after he left the office in 1989. Admittedly, one of the major drivers of the U.S. stock market over the past decade or so has been the stock buybacks on steroids due to an increase in money supply courtesy of the Fed having printed trillions of dollars. Coupled with a backdrop of practically near-zero interest rates since the 2008 Great Recession, the executives and gamblers alike have therefore been incentivized to borrow dirt-cheap money so as to pour them into the stock market in the hope of making a killing. Such a speculative behavior has been further run amok to the nth degree in the form of cryptos, non-fungible tokens, special purpose acquisition companies, or SPACs, and meme stocks. The stocks of virtually bankrupt and zombie companies heavily traded on the market and catapulted to the sky merely due to their popularity on social media rather than their corporate fundamentals, only for them to come back crashing to earth and leaving fools holding the bag. In particular, the irrational exuberance of gamblers propelled the U.S. stock market to become extremely frothy and bubblicious as 2021 drew to a close, a la its fate prior to the 1929 crash as gauged by almost every metric available. A once-in-a-lifetime crash is thus once again in the offing, and like the 1929 crash, it will also leave decamillions of fools and horses without clothes. While doomers and gloomers have been calling for such an earth-shattering crash for decades, little they understand that it does not occur randomly, but rather its odds dwindle as a human society walks past annus horribilis of Oqual cycle, as it did some 84 years earlier in 1944, but then they begin to swindle as it cycles back to that horrible year, as is the case today with the next annus horribilis 2028 barely years away. Simply put, the odds of once-in-a-lifetime crash in the stock market or other assets such as real estate with the potential to wipe out the life savings of decamillions ebb and flow in tandem with the progression of Oqual cycle as exquisitely captured by the crash Aqua cycle. Notably, the 1929 crash uncharacteristically transpired earlier by about a decade than what might have been forecast by the Oqual gods. A reminder that the Oqual cycle is not set in stone, but rather the exact timing of fallout from our excesses and imbalances is determined by an interplay between human behavior and astronomical factors. With the annus horribilis 2028 of the current Aquanium barely years away, it seems that the stock market bubble is likely on its last leg before it comes crashing down to earth in what would go down in the annals of history as a once-in-a-lifetime crash on a scale comparable, if not greater, to the 1929 crash. Admittedly, barely a week into 2022, the stock market bubble seemingly began to pop one last time. In 2023, more than a year after it hit what was a record high, the popping of the stock bubble bears the hallmarks of a crash that is just getting started, and it will be a long and bumpy ride before it shows any signs of bottoming out. Given that the world is teetering on the brink of World War III with so many dark clouds hanging over our head and shoulders, the stock market is indeed set to continue rolling downhill for many years to come, though it will likely be interrupted by bear rallies every now and then. Nevertheless, a new and powerful bull run will likely get underway on the other side of Annus Horribilis 2028 of the current Aquanium, just as preparations get underway for the start of a new dawn of hope and prosperity. It would therefore pay to build cash reserves now and beef up the dry powder so that it can be deployed when there is blood in the streets. Still, it is important to remember that plowing money into the stock market is not an investment. It is a speculation at best, a Russian roulette at worst, and a casino for all intents and purposes. Indeed, there is a reason as to why Warren Buffett has been dubbed the Oracle of Omaha. He is the most successful gambler of all time due to his investment prophecy rather than investment philosophy. Had Buffett's big bet on the likes of Coca-Cola during the 1980s gone bust, and it should have given the exorbitant toxicity of that filthy beverage, none would have ever heard of him. If you rather invest your money, then lend it directly to private and public companies when they issue bonds rather than merely gambling and betting on their market value through trading their stocks.